Good morning and welcome to the CARCLO PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Joe Oatley, Chair. Good morning, sir.
Good morning, everybody, and welcome. The first thing I want to say really is I'm extremely proud of what our team has achieved in the last year. I know how hard everyone has worked to deliver the results that we've seen today. It's a little over 18 months, about a year and a half ago, that Frank took over as CEO, and we implemented a new strategy to first focus on building a strong foundation for the business with a drive for operational excellence to deliver higher margins and strong cash generation. You'll hear from Frank in a moment about the excellent progress we have made on executing that strategy, with continued strong performances from our aerospace business, our technical plastics business in Europe and Asia Pacific, and the turnaround of our US business, which is now well underway. You'll then see, when Eric takes you through the financial results, how this is now starting to bear fruit, with strong cash generation in the year, improved margins, and significantly improved return on capital. When I look forward, we'll continue to strengthen our foundations. In truth, the work on operational excellence is never really done, but I'd expect as we move through the year ahead of us, we'll start to bring in a renewed focus on growth and expansion, and Frank will touch on that towards the end of his presentation. With that, I think I'd like to hand over to Frank. We'll start by taking you through the highlights of last year. Frank.
Thank you, Joe. So welcome everyone to CARCLO's FY24 preliminary results presentation. Today we'll delve into our strategic progress and financial performance over the past year. As Joe alluded to, I'm Frank Doornbos, CEO, and I'll be guiding you through our journey of transformation. Our agenda today includes the introduction of strategic initiatives, a detailed review of business highlights, a financial update, and an outline for future strategy and outlook. We aim to provide you a comprehensive review of our achievements and the roads ahead. On the health and safety, we are working on building a much stronger health and safety culture in the organization, therefore demanding reporting any health and safety incidents which has occurred in the business, going up from a paper cut. That has resulted in much better insight, but of course has resulted in a higher total incident ratio of 2.28, up from 147 the year before, but even down from the FY22. I'm happy to announce that the lost time accident frequency ratio has dropped to 0.3, which is 20% down on the year before. The success is the dedication of everyone, is the fact that we celebrate annual CARCLO Safety Week now for the second time. And within CARCLO, we do try to stay alert to not get hurt. And this is one of the key pillars of our organization. This year, we saw significant progress on our strategic initiatives. We're driving improved profitability despite challenging market conditions. And for more on the market conditions in the later slides. At constant currency, our overall sales went down by 4.5%. But our underlying EBIT went up by 24%, marking the success of our strategic direction. Manufacturing sales declined, which was in line with our deliberate margin over volume strategy and the closure of our short-run business. Our design and engineering sales went up, driven by our asset revitalization project. And I'm particularly proud on the development of aerospace, achieving a 40-year record sales. The sales growth in aerospace and the effect on focusing on offering in our CTP business, combined with operational excellence and a rigorous cost management, has resulted in an underlying EBIT of 6.6 million, which is constant exchange rate is up by 24%. Our return on sales improved to 5% from 4.1% in FY23, and we made good progress in the return on capital employed, reaching in FY24 13.1%. As we move closer to our target of 25%. So let's look at the performance across our key regions. The current geopolitical situation in China is hurting our global customers we serve in the region. We have moved towards serving the growing local customer base to keep our growth on the medium term. Our APAC facilities are leading in material and processing improvements and are currently developing our new standard back-end automation system, ready to have a global rollout in the next 12 to 18 months. Our EMEA operations have completed the factory specialization and are now moving into the phase of material and processing improvement, working closely with our colleagues in the APAC region. We're sustaining growth with key life science customers, and we're capitalizing on strong demand in the drug delivery systems in the EMEA region. In the US, where we have reduced by 6.6%, sales declined due to a deliberate curtailing of our unprofitable and the short-run business. Versus FY23, we're also impacted by our customer destocking as COVID-19 PCR test demand reduced. We're currently consolidating our US activities into one cost-efficient operation in Pennsylvania. We closed our dairy site in Northampton as it was predominantly focused on short-run business, and we're currently in the process of transferring capacity from Tucson to complete the centralization of talent and operations in Pennsylvania. The aerospace division is expanding its precision machining solutions, besides benefiting from increased air travel. We will follow customers into South Asian markets and investing in new machine technology across all sites to support the growth. So I would like to highlight the progress on the 4 key strategic priorities we discussed last year. We have strengthened our balance sheet through strategic capital investment and rigorous working capital management. As a result, our working capital as a percent of sales has improved to 7.9%, down from 11% in FY23 and 22% in FY22. Our improved EBITDA, combined with a strong cash generation, has allowed us to lower our net debt to EBITDA ratio to 2. We're maximizing asset utilization by harmonizing machines, robotics, and processes across all sites and fostering the one CARCLO vision to join and work together in the best global practices. Our revenue to tangible fixed asset has improved to 3.3, and the average machine runtime is up to 12.5 hours per day. Our focus on prioritizing margin over volume is paying off, and the focus approach has allowed us to improve our contribution margin from 32% in FY23 to 36% in FY24. And finally, we're maximizing the value of our global footprint by working together to enhance operations, create dedicated manufacturing locations, boosting efficiency, quality, and performance, resulting overall in a better customer experience. I am pleased to report that we have made significant progress on factory specialization across all regions. On the challenging market environment, allow me to provide you with an overview, which is characterized by both challenging and opportunities across 4 key areas. In terms of sales, we're navigating a complex landscape, as while the in vitro market has experienced a temporary downturn due to the reduced COVID-19 PCR testing, the long-term growth trajectory remains positive. We're seeing encouraging growth in drug dispensing market, driven by increased focus on self-care. Our aerospace division continues to benefit from the revival of air travel and our strategic regional and product extension. The cost environment remains challenging. We continue to face headwinds in our plastic resin supply chain, and steel mills producing aerospace-grade materials are grappling with substantial order backlogs. Operational costs have escalated due to the persistent inflationary pressure, particularly in labor and essential services. Regarding polymer and energy, we've observed a general upward pressure on polymer cost, partly due to the partial reversal of crude oil prices reductions seen in FY23. Energy prices remained elevated, influenced by the ongoing geopolitical tensions. To mitigate these impacts, we're intensifying our focus on reducing scrap, improving our energy efficient ratio, and streamlining processes to offset rising costs. Turning to Economic indicators. We are closely monitoring several factors. Geopolitical tensions have created challenges for Western companies operating in China, affecting our market position there. On the interest rates, in the UK-based interest rates have seen a significant shift, averaging from 5% in FY24 up from 2.3% in FY23, impacting our financial expenses. Reduced discount rates have led to increased pension interest, causing our liability to grow more rapidly than our assets. On a positive note, our aerospace business has benefited from the rebounding of economic activity and the research of air travel. The multifaceted market dynamics continue to inform our strategic decisions and financial outlook. We remain committed to navigating these challenges while capitalizing on emerging opportunities to deliver sustainable value to all our stakeholders. I will now hand over to Eric, our CFO, to go in more detail on our financial performance.
Thank you very much, Frank, for that comprehensive introduction and overview to CARCLO, where we're delivering the strategy in action in FY24. I'll take you through the key financial numbers. Turning to the key performance indicators, here we've set out the half-yearly record over the last 4 years for the KPIs. You can see the development in the revenue stream, and as Frank noted, that we saw in a rolling trailing 12-month indicator that we are down year on year on reported numbers by approximately £10 million, 143.4 down to 132.7. However, 4.5 million of that is due to foreign exchange translation, which would lower the FY23 figure. So the actual drop, as Frank noted, is considerably lower, 4.5%. If I look at the underlying operating profits, you can see the increase to 6.6 million for full year 24. That compares to 5.9 on a reported basis, or 5.4 million on a constant translation basis. But the 6.6 million is near to the high of 7 million in our 4-year record. That in turn, on the bottom left, has driven up the return on sales on a full year basis. You can see now that we're heading back towards the 6% that we saw in full year, first half year of 22, up considerably from the first half year in FY24. On the bottom right, the underlying earnings per share is a more volatile number, and that's clearly been impacted heavily by the increase in interest charges principally, but we're now back in positive territory at 1.1 pence on an underlying basis. If I turn to cash generation, this statistic is the trailing 12 months conversion of EBITDA into cash. And you can see we had extremely strong cash performance during the second half of FY23 and accelerating through in first half and full year FY24. That in turn has enabled us to reduce the net debt. So we opened in FY21 at 20.5 million, in first half year 24.4 million of bank debt. We're down to 18.3 net bank debt. You can see there's an increase in finance lease creditors, but bear in mind that this also includes a capitalization of factory rentals under the standard. So whilst it's a bigger number, most of it is already a committed rental for the property, about half of this number. This has also helped us drive return on capital employed up to 13.1% compared to 9.7% last year, and an increasing number through the second half year. And as Frank mentioned, that our fixed asset utilization, as we've controlled capital spending, has now moved up to 3.3 times, well up from full year 21 at 2.5 times. I turn to the income statement. Here you can see that the Margin has expanded. If I look at the contribution margin level, gross profit margin level, we're up to 36% compared to 32% last year. Bear in mind also the impact of foreign exchange. We've reported the £500,000 on foreign exchange translation, but there was also £800,000 worth of foreign exchange transaction gain in FY23 that didn't repeat in FY24. So our underlying improvement in profit is actually stronger than it first appears. We have significant exceptional items being expensed here, nearly £4.9 million, mainly to do with the reorganisation and restructuring of the businesses in the UK and the US. But please note that the cash cost of these exceptionals is actually only £600,000 in the period. Turning to financial income and expense, you can see the significant increase in net finance expense to 5.6 million compared to the prior year, reflecting the higher interest costs that we are suffering in the market generally. As Frank said, going up to 5% base rate from 2.3%, despite the fact that we've been paying down debt. If I turn to the second half year, you'll see a substantially increased performance in the second half year, with underlying operating profit of £4.4 million. A lot of the exceptionals kicked in during the second half year on our US restructuring. But you can see here our return on sales in the second half year was 6.7%. So we're well on track to head towards our goal, the medium-term goal of 10% return on sales. And clearly we've got momentum running here as we start the new year in FY25. I turn to exceptional charges. Here you can see the rationalisation costs of nearly £3.4 million, reflecting the restructuring of what's been going on in the business, primarily in the US. The £1,020,000 is to do with pension equalisation that was required as a result of legal challenges across the whole pension world, and that's a non-cash item. Debt refinancing costs, we had significant expenditure in FY23 as we went through covenant resets. The debt financing costs this year are really preparing the company to start a process to refinance the business going into FY24. The other items are really to do with tidying up issues on exceptional items in prior years. Turning to the financial expense, again, you can see here the interest payable on bank loans and overdrafts up to £3.1 million compared to 2.6, but the imputed lease interest cost was also up significantly. But the real impact here, as Frank mentioned, was the imputed interest on the defined pension liability. As the liabilities increased, the imputed interest charge on pensions goes up. And I've set that out in the table below. You can see how that's developed compared to last year. So 1.8 million compared to 0.7 billion pounds. We'll turn to the underlying operating profit bridge. Here you can see on the left-hand side, I've taken the 500,000 of foreign exchange translation impact on the prior year number, but also noted the £800,000 foreign exchange transaction that didn't repeat in FY24. So in terms of bridging from one year to the next, the base year is really £4.6 million, excluding foreign exchange impacts, growing to the 6.6 million. We can see the 2.2 million reduction due to the reduced revenues year on year, but a £4.9 million expansion due to the margin expansions that we've been working on improving operational efficiencies in the business. Factory costs pretty much held year on year, slight benefit of £100,000. The selling general administration costs increased by 800,000, and that's primarily looking at expanding our talent pool to drive the business and put us in a better place going forward. In terms of the pension, this is the report under IAS 19, so it's the accounting presentation of the movement in the pension funds. And here we've seen discount rates moving and the corporate bond rates moving, and that's ended up with a net increase in our deficit under IAS 19. This also includes that past service cost increase of £1 million that I mentioned previously. I think the thing to note with the pension is what really matters are the deficit under the technical provisions that are set by the actuaries of the pension scheme. And we last reported that it was £82.8 million at the valuation in FY21. So in March 24, there's another full actuarial valuation going through. All the indications are that we should see a significant decrease in that technical provisions liability. Financial position is really a summary of the balance sheet. And here you can see our controls over capital expenditure coming through. Tangible fixed assets are 40.1 million. That also includes the impairments that we put through on business sites that we are closing, compared to 45.3 million the prior year. And as you noted at the half year, we saw a considerable reduction in working capital. Year end, we've pretty much held and improved our inventories down to 11.3 million. Our net working capital position is now 800,000 net liabilities, and that's largely compared to September, the movements on contract assets and liabilities, which are to do with revenue recognition. So net working capital is down year on year by £5.3 million. Improving our working capital ratio to revenues. Net assets employed down from 61.1 to 50.6 million, helps us drive the return on capital employed from 9.7% to 13.1%, and the cash generation has been applied, as I mentioned, to reducing net debt, so down from 34.4 million to 29.5 million. That in turn has enabled us to deliver on a much improved net debt to underlying EBITDA ratio, down from 2.5 times to 2 times. And just note that we have extended our bank facilities to the 31st of December 25, extension of 6 months, showing the support of our bank to the company, HSBC. And at the end of March 24, we had 3.2 million undrawn on the revolving credit facility. I'll turn to the cash flow. Here you can see the improvement in underlying EBITDA, but the main feature here is the change in working capital I've referred to. So year on year, that's a turnaround benefit of 5.8 million in terms of the working capital improvement. Interest payments going up by 1.2 million, and the pension contribution being pretty stable year on year, ending up with cash from operating activities of 10.4 million compared to 3.8 million for full year 23. So that's a year on year improvement of 6.6 million. The net capital expenditures here show the cash purchase of fixed assets, but in terms of cash flow purposes, it shows the cash going out to the pension lease payments, so 6.6 million. So we're still investing in the business to a certain extent. That leaves us with free cash flow of 3.6 million compared to an outflow in the prior year of 2.4. Again, a £6 million improvement. If I look at net debt as a bridge, we started at 34.4 million, negligible foreign exchange impact on the balance sheet net debt. Operational cash was the main contributor to reduction in net debt, and then enhanced and expanded by our working capital management improvements. Net capex in cash terms at 2.8 million, the 600,000 one-off cash expense on exceptional items, and the contributions into the pension fund of 2.4 million, and net interest outgoing of 3.8, and tax payments in line with the prior year. But we reduced our net debt to 29.5 million, so really very strong cash generation, significantly reduced the net debt. And to summarise on net debt, this sets out the history of development in improvements in the EBITDA ratio to net debt, as we reported down to 2 times, back against the historic number, which is more like 2.5 to 2.6 times. Thank you. With that, I'll hand back to Frank to discuss the strategy.
Thank you, Eric, for that comprehensive financial overview. So let's now shift our focus to how we're leveraging these financial realities to drive our operational excellence and growth initiatives. At CARCLO, we empower innovation and sustainability through precision engineering worldwide. On the right side of the slide, you see the point of differentiations, how we position ourselves into the market. Really important, going on what Eric has said, we are supporting our strategy for a relentless focus on margin and cash conversion, as cash will stay king at CARCLO. Our measures are multiple, through cost management, operational excellence, margin over volume focus, to working capital and investment discipline, allowing us to invest and reduce our debt to improve the financial health of our company even further. On the strategy, our strategy going forward is based on 3 key layers. Layer 1 is the foundation, 2 is the expansion, and 3 is proprietary. On foundation, we started with health and safety and building relentlessly to create operational excellence in our operations. By streamlining our procurement process globally, we are now going to achieve greater efficiency and cost effectiveness, allowing us to enhance our competitiveness further. On control and reporting evolution is another key building block of our foundations. We have implemented advanced control systems and comprehensive reporting mechanisms to ensure accurate real-time data tracking and analysis, enabling us to make informed decisions data-driven, maintaining financial integrity and drive continuous improvement across all facets of our business. On the expansion, with the strengthened foundation, we can now move our focus to multifaceted growth. This includes capitalizing on market momentums in the markets we operate, growing our share of wallet with existing customers, acquiring new customers, and expanding into new strategic markets. Our aerospace and optics businesses are leading this charge, based on the fact they run their business on a very solid foundation. On proprietary, we see that the unique proprietary technology, materials, and products is the longer vision of CARCLO. We are setting up an incubator organization, CARCLO Life Tech Solutions, harnessing and accelerating innovations. Our target is to develop proprietary technologies, materials, and products that will drive our future growth and differentiation. So, what does a robust operational base mean, and what do we talk about when we talk about a journey? So let me illuminate you on that. Yes, we've initiated this transformation with factory specialization, what we talked in all our presentation. It's a cornerstone of our strategy and setting new standards in our organization. But that is just the first phase of our journey. It is followed by materials and processes optimization, coupled with back-end automation. Our long-term vision is a lights-out manufacturing with interconnecting systems, moving from our current Industry 4.0 connecting machines to Industry 5.0 connecting people. This comprehensive approach allows us to work on operational excellence and underpins our commitment for sustainable growth and shareholder value. You here see the growth and the status of our different regions in that journey. EMEA and the APAC are leading the pack and moved into material and operation. They have set new standards, how factories should look like, and they're totally focused on getting the value out. And the business is run totally data-driven, allowing us to see everything which is going on in the business and move on continuous improvement. As we said, the US is in finalizing the consolidation in Pennsylvania and is moving there into factory specialization with different allocated cells. We are completing the process during FY25, and we see further improvements in our results coming from that project. And the next layer is the multifaceted growth strategy. Today, propelling by our aerospace and optics businesses going forward. Each built upon, as I said, the robust operational performance. Our aerospace division is not merely capitalizing on market recovery. It is strategically diversifying its offering. We're forging new strategic partnerships, leveraging our competitive edge in short series, high-precision aerospace parts. This focused approach allows us to play to our strengths while expanding our market reach via strategic partners. Moreover, we have successfully followed our customers into high-growth regions, notably growing in South Asian markets. Our geographic expansion underscores our commitment to servicing our customers wherever their business takes them, leveraging our global footprint. In our optics business, we're transcending traditional boundaries. While maintaining a strong position in headlight aftermarket, we're increasingly moving towards more sophisticated light management solutions. In these innovative applications span architectural, horticultural, and safety lighting, where bespoke light design is paramount. The strategic shift is elevating our business proposition and is attracting a new caliber of clientele. The direct sales route of our coil eye care business is gaining traction, and on the side, we are developing niche product lines for high-end OEMs. These initiatives are opening up fresh revenue streams and reinforcing our market position, as we've seen in the growth of these two businesses. Let's turn our attention to our expanding sustainability initiatives, encapsulating in our Zelda project. The key element is to foster a culture of sustainability throughout CARCLO, aligning our people and operations with global environmental targets. We have systematically phased out energy-intensive machinery, replacing a sharp focus on optimizing resource utilization across materials, energy, water, and other key inputs. This approach not only reduces our environmental footprint, but also drives our operational efficiencies. Recognizing our position as a substantial electricity customer, we have made strategic decision to transition to renewable energy resources. This initiative is launched in the UK with plans for broader implementation across our global operations. You also see that for the fourth year in a row, we have improved our CO2 efficiency to 143. On the EcoVadis sustainability rating platform, we've advanced from the top 51% of companies last year to the top 35 this year. While this improvement is noteworthy, we acknowledge that there is considerable room to further improvement, particularly in our procurement practices. Consequently, this has been established as a key objective for our newly formed global procurement team. Our commitment to sustainability is not merely about compliance. It is a core part of CARCLO's business strategy. We believe that by prioritizing sustainable practices, we're not only fulfilling a corporate responsibility, but also creating long-term value for our shareholders and stakeholders alike. So, to summarize, to encapsulate our progress, we've executed a strategic realignment of our global operations in response to challenging market conditions. This involved carefully orchestrated site closures and asset consolidations, which have markedly enhanced our core competencies and operational efficiencies. Realizing sustainable gains in both production efficiency and profitability through the implementation of cutting-edge machining technologies and sharpened focus on product specialization increased our results. Our financial robustness has notably improved, as evidenced by the enhanced return on capital employed and the underlying earnings before taxes. These metrics underscore the effectiveness of our management strategy and the prudence of our strategic investments. This triad of operational streamlining, efficiency enhancement, and financial strengthening has transformed CARCLO in a more agile, innovative, and financially sound entity. We stand ready to navigate further challenges and seize new opportunities in our evolving market landscape, driving sustainable value to our shareholders. On our strategic journey, it's anchored on the three fundamentals of business foundation, expansion, and the financial health reinforcement. In our business foundations, we're at the final stages of our US factory specialization project, a key initiative to centralize and optimize production capabilities. Concurrently, we're progressing to the next echelon of operational excellences through material and process enhancements, as has already borne its fruits in the APAC region and starting to bear fruit in the EMEA region. We're also executing a strategic sourcing initiative to bolster supplier relationships, elevate overall business performance, but not least to enhance our resilience in our supply chain. In our expansion strategy, we're strategically targeting unserved regions and sectors to improve our market share. This approach is completed by our focused efforts in diversity revenue streams, also addressing new strategic markets. To ensure our financial health, as Eric said, I said, everybody knows, we keep prioritizing market, margin, and cash flow management. We're also determined to reduce the net debt to EBITDA ratio. This all to continue a robust financial stability and prime us to capitalize on further investments opportunities as they arrive. This comprehensive approach underscores our commitment to sustainable growth, long-term value creation for our shareholding, and positioning CARCLO to continue success in an increasing competitive global market. Looking ahead, our strategy is clearly defined and focused on both short-term improvement and long-term value creation. In the immediate future, our primary focus remains on strengthening the foundation of our business. We anticipate continued market expansion in FY25, driven by the benefits of our US manufacturing rationalization and improvement program. This positive trend is expected to extend to FY26 as we then realize the full year impact of our operational optimization initiatives. These efforts are propelling us towards our strategic goals of achieving our 10% return on sales and 25% return on capital employed. Concurrently, we are maintaining a sharp focus on disciplined cash management, aiming to deliver strong operational cash conversion in FY25. As we transition to the medium and long-term horizon, our strategy shifts towards an expansion phase. We're poised to drive robust top-line growth by capitalizing on structural market growth, increasing share of wallet of existing customers, and throughout this growth phase, we will maintain our commitment to capital and operational discipline, ensuring that our expansion translates into strong earnings growth. This balanced approach, optimizing our current operations while strategically expanding our market's presence, underpins our unwavering commitment to create long-term value for all stakeholders. We're confident that this strategy positions CARCLO to navigate near-term challenges, capitalizing on future opportunities, and ultimately delivering sustainable growth and shareholder value in an evolving global market landscape. Thank you very much. Hand over to Joe. I think we're now ready for the Q&A.
Joe, Eric, Frank, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the right-hand corner of your screen. Just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation. And Joe, could I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
Yes, of course. Just before I go to the first question, could I ask, there's been one submitted by Simon C. Would you mind, Simon, just resubmitting it just to clarify whether you're wanting to get an explanation of where the ongoing margin expansion is coming from, or whether you're interested to find out where we think our medium-term growth is going to come from. I wasn't quite sure from your first question which was you're after. So if you wouldn't mind just resubmitting while I read out a couple of the other questions, that would be great. First of all, I think this one's for you, Frank. You very, very briefly mentioned when you were talking about strategy, something about proprietary products. Are you able to give any additional details on this?
Yeah, I think it's a good question. We take proprietary products as something which will be our long-term growth, but this company has a history of promising the world and not being able to deliver. We have said we were going to do work on it. We start the incubator project, and we will talk about the elements before when we have something in the marketplace. Also, it wouldn't be good to say what we're doing here because our competition might be listening in and seeing what we're doing. So those two elements we're not able to talk about it further, but the business will be set up, and you will be hearing from us very soon.
Thank you, Frank. Next one is from Ben. How has the strategy of factory specialization and standardization improved operation efficiency? And what are the metrics that you're using to measure this improvement?
Yeah, what we have done, we have changed long-term. We defined long series or long-run factories and short-run factories. Long-run factories, we are focusing on the last second of the cycle time, getting all the back-end automation out and standardize all the processes, while the medium-run businesses are focusing on their agility, reactiveness, etc. And I believe if you do something, you focus on something specifically, you will become very good at it. And we are seeing in EMEA, where we have the long-run business in our UK facility and the medium-run in our continental facility in the Czech Republic, and we see that the operational improvements become, how do we measure it? We start in the phase of factory specialization with measuring OEE, overall equipment efficiency, and the amount of runtime and the scrap values. And we've got a comprehensive online system ready. We have all the insights, and that has helped us. That focus helped the performance because people can do one element, focus on that. And our investments to long-run business will be in back-end automation, and our investments in medium-run business will be on quick changeovers.
Thank you. Whilst we're on, Ben, since you've submitted a second question, Ben, what percentage of revenue is being invested in research and development, and what are the key areas of focus for R&D? So there's two parts to the question. I think, do we disclose?
We don't disclose.
I don't believe we do we?
No, we do development work rather than research work, and it's really our engineering efforts in our design and engineering business that really drive that. And there's also investment in developing new machining techniques in aerospace. And
of course, the answer that Frank gave when there was the question from, I think it was Emma, on proprietary technology, that is obviously an area of R&D for us going forward. Simon, thank you for the clarification. So Simon was after an understanding of, okay, what is the medium-term focus for our revenue growth? I think, so again, Simon, if I'm getting that wrong, please submit another question. If it's a question about our medium-term focus for margins, again, submit another question and we'll come back to it. But first of all, Frank, where you think revenue growth is going to come from in the medium term?
Yeah, in the medium term, you have to realize that in the life science business where we operate, you have a long term of validation to do before we can put something to the market. So sometimes projects come in a design engineering, and then takes a long time before it gets into manufacturing. But we're expecting on the medium term to go. Our growth rate will lay at least two times GDP. But if we get the things right in the growth, multifaceted growth, we will think about a growth rate of around 5 to 8%. Should be a doable growth rate if we're successful. But the point is, when does it start? is very depending on the validation of our customers of the new ideas, the new products, and the new materials.
Thank you. And then there's it's more a comment from Chris. Full disclosure, I'll read out the comment. Less than 3 hours to read the results doesn't give me enough time to see if I want to question anything. Apologies for that, Chris, but I think absolutely industry standard. We aim to get the presentation out in that sort of 3-hour period after the results come out to make sure everyone has quick information from the management team to explain the results and explain what's been going on. So I think you'll find that's absolute industry norm. Apologies, I recognise that doesn't give you a lot of time, but that's the way the world works. One just come in from James. The company mentioned a focus on focused innovation incubator engine, which again, there was a question on this earlier. Can you provide any more details on the structure and expected outcomes of this initiative? I think, Frank, you covered that really in the answer to the question earlier from Emma. We want to give a tiny bit more.
Yeah, a tiny bit more. So we run it as an incubator project. You know, if you're restructuring a business, there's a lot of things going on, and then some things sometimes do not get progressed rapidly. Innovation and something which is going to create value in the next 4 or 5 years will be lower on the pile. So not to undervalue that development, we're going to create an incubator project, an incubator organization, and that will report to me, keeping focus on the innovation and keeping focus. The directions, as we said, manufacturing technologies, so all proprietary, unique manufacturing technologies, specific materials development, and specific products, mainly focused around sustainability.
But just for clarity, this is a real long-term proposition. So don't, just to make sure everyone understands, don't expect to be seeing outcomes from that in the next year or two. It's much longer term than that. Yeah. Okay, I think that is all of the questions. So I just wrap up from here.
Joe, Eric, Frank, thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Joe, could I please just ask you for a few closing comments?
Yes, of course. First of all, thank you to everyone for attending today. I'm sure you'll agree it's a very positive set of results showing the progress we've made on executing the strategy, stabilising the business, and building the strong foundations for the future. I look forward to this future with optimism. I hope we will have your ongoing support as we continue to deliver on our strategy. Thank you very much.
Thank you.
Joe, Eric, Frank, thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of CARCLO PLC, we'd like to thank you for attending today's presentation, and good morning to you all.